Have you noticed something strange lately? Stocks fall. Everyone screams, buy the dip, and then the stock keeps falling anyway. Support breaks. Retail traders panic. And suddenly, what looked like a perfect entry becomes a disaster. So, what changed? The answer is simple. The market is no longer controlled mostly by humans. Today, algorithms and institutional AI systems dominate short-term price movement. And if retail traders continue using old strategies in a new market, they can get destroyed emotionally and financially. In this video, I'm going to explain why traditional buy-the-dip trading keeps failing, how institutions actually enter positions, and how leaps traders can use patience and probability instead of emotions. And don't worry, I'm going to explain this in very simple terms. Welcome back to Cheryll Trades Leaps. On this channel, we focus on leaps investing, market psychology, patience, and realistic long-term trading strategies. Because the goal is not gambling. The goal is surviving long enough to let compounding work. And today we're talking about something extremely important, why the market changed, but most retail traders didn't. Section 1. The old way of trading. For years, many traders learned, draw support lines, wait for pullbacks, buy the dip, and hold for the bounce. And honestly, sometimes that still works. But here's the problem. The market today moves differently than it did years ago. Why? Because algorithms now dominate huge amounts of trading volume. These systems react faster than humans, emotionally colder than humans, and often hunt areas where retail traders place their orders. That's why you'll often see support breaks suddenly, sharp fake sell-offs, and violent reversals. The market became faster and much more aggressive. Section 2. The retail trap. Here's the mistake many traders make. A stock falls to support. Retail traders instantly think, this is the dip, so they buy immediately. But institutions often wait longer. Why? Because big money wants panic, fear, emotional selling, and weak hands to exit first. Think about it like this. If institutions want to buy millions of dollars worth of shares, they want better prices. And the easiest way to get better prices is letting fear push prices lower first. That's why many dips keep dipping. Section 3. What smart money watches? Instead of asking, did price hit support? Smart money asks, is selling pressure slowing down? That's a huge difference. They don't just look at price. They watch behavior. Example, if terrible news comes out, but the stock suddenly stops collapsing, that's important. Why? Because it may mean the big sellers are running out. And when selling pressure dries up, price can reverse very quickly. This is often where institutions quietly begin positioning, not during excitement, during emotional exhaustion. Section 4. Why this matters for leaps. This becomes extremely important for leaps traders. Because leaps are long-term options, and timing matters. If you buy too early, your option can lose value, volatility can hurt you, and your capital gets trapped while price keeps falling. This is why patience matters so much. The goal is not catching the exact bottom. The goal is waiting until probability improves. That's a professional mindset. Section 5. The big clue most people miss. One of the strongest clues in the market is this: when bad news stops pushing price lower. Think about that carefully. Sometimes, earnings are weak, headlines are negative, fear is everywhere, but the stock stops falling aggressively. That often means most of the panic selling already happened. This is where momentum can quietly begin shifting. Not because retail traders suddenly became bullish, but because institutional selling pressure disappears. Section 6. How to position more intelligently. Now let's talk about position sizing. Many traders go all in too early. That creates emotional pressure. Instead, smart traders scale slowly. For example, small starter position first, larger position after confirmation, biggest position only after momentum stabilizes. This reduces emotional trading, panic, and oversized mistakes. And honestly, this is one of the biggest differences between gambling and professional execution. Section 7. The new way to think about the market. The old retail mindset says, predict the bottom. The smarter mindset says, wait until selling pressure weakens. That changes everything. Because now, you are no longer fighting the market emotionally. You are observing it patiently. And patience is one of the biggest edges retail traders still have. Algorithms are fast. Institutions are massive. But patient traders can still win by waiting for high-probability moments. Final message. The market changed. Algorithms dominate short-term movement. Volatility is faster. Fake breakdowns happen constantly. And blindly buying every dip can become dangerous. But here's the good news. You do not need to predict perfectly to become successful. You simply need patience, discipline, smart risk management, and the ability to wait for probability to improve. Because trading is not about proving you're right. It's about surviving long enough for opportunity to come to you. If you enjoyed this video, subscribe to Cheryll Trades Leaps. On this channel, we focus on Leaps investing, market psychology, institutional behavior, and realistic long-term trading strategies. And remember, stop trying to catch falling knives. Start waiting for selling pressure to die. Thank you for watching, and I'll see you in the next video.